Thanks for watching, everyone. For our latest Artemis Live video interview, I'm delighted to welcome Scott Slater from PwC. Now, Scott is a partner and also the tax services leader at PwC Bermuda, and he leads PwC in the Caribbean's International Tax Services Group as well, which is based across Bermuda and also the Cayman Islands. Scott has more than 17 years of industry experience gained while living in Bermuda and working for PwC. Now, this team is focused on assisting captive insurance companies, international insurance and reinsurance companies, and also hedge and private equity investment funds with their US and international tax accounting, planning, investor reporting, and compliance matters. So he's got a wealth of experience to talk about some of these mostly tax-related issues with us today. So welcome, Scott. Really good to speak with you.
Thanks, Steve. Great to speak with you as well.
So today with Scott, we're going to talk about recent tax developments and how they could affect insurance, reinsurance, and they may also have some relevance for the ILS market interests as well. So first, Scott, perhaps you could briefly discuss how your team supports the needs of clients operating in Bermuda and the Cayman Islands.
Sure. As you'd expect in Bermuda and the Cayman Islands, it's primarily a financial services focus. And with that, primarily being a U.S. tax group, we focus on U.S. investment into entities in Bermuda or the Cayman Islands, whether that be insurance, reinsurance vehicles, ILS vehicles, as well as hedge funds and private equity funds. In the U.S. tax world, as U.S. taxable investors investing offshore, there is certain types of reporting and taxable income pickups that are required for those U.S. investors, and we help them kind of navigate the complexity around that, as well as get them the information they need to pay ultimately pay the taxes that they need to do in the U.S.
Sure. So one of the hot topics in tax circles is the global antibase erosion. It's often called GLOBE, minimum tax pillar 2. So quite a technical term there. Can you give us an update? Perhaps you could give us a brief overview of it and then give us an update on how these rules are intended to work and how they could ultimately impact the Bermuda marketplace.
Sure. So pillar 2 is an interesting development given the kind of various countries across the globe working in unison around taxation, when kind of historically it had often been very bespoke, and each jurisdiction takes care of its own taxes without much input from other jurisdictions and how they do that. And this is certainly outside of the U.S. tax sphere, but how the pillar 2 specifically is looking to work is to achieve this global minimum tax for large multinationals. I think that's the first thing to be kind of focused on. Is this is only looking at multinational enterprises, so companies, not individuals, and also larger multinational enterprises. So the threshold for this is 750 million euros of annual turnover. So we're looking at large companies here, not your more mid-sized or small companies. And I guess kind of as we work towards the specifics to Bermuda, how do you achieve a global minimum tax? That the way pillar 2 goes about this is under 2 different regimes. One is the income inclusion rule, or the IIR, and the other is the under tax profits rule, or UTPR. And these rules can work in unison to ultimately achieve this global minimum tax. And how it works in a kind of using Bermuda as an example, the IIR is the first step, and that involves if you have a parent company in a taxable jurisdiction that has a subsidiary in another jurisdiction that pays less than 15% of tax on the income inside of that jurisdiction, the income inclusion rule is a mechanism for the parent company to pay tax on the income of the subsidiary in a lower tax jurisdiction. So kind of playing that out in the Bermuda context, if we have a Bermuda reinsurer, which is a subsidiary of a parent holding company that may be in France or Japan, any jurisdiction that's looking to bring in pillar 2. Let's say the Bermuda subsidiary makes $100 and currently is not subject to tax on that $100. If we have a French parent, for example, the $100 earned in the Bermuda subsidiary, that same $100 would be taxed at the French parent at that 15% rate to ultimately achieve that global minimum tax that they're trying to achieve. And then kind of outside of that IIR or the parent company paying the tax, there's the secondary mechanism, which is the UTPR. So for example, again, using Bermuda insurance and reinsurance market as an example, we may have a Bermuda parented company. So Bermuda parent, Bermuda reinsurance subsidiary, and let's say they have a UK or French affiliate, another subsidiary in the structure. So if the parent company is not in a jurisdiction that brings in these rules, so again, Bermuda reinsurer would earn $100, no tax on that as currently legislated. And then if the parent company also does not bring in the IIR, which would subject that $100 to a 15% tax rate, the UTPR causes the kind of brother sister subsidiary jurisdiction to pay tax in that jurisdiction. So again, kind of Bermuda parent, Bermuda reinsurer. Let's say we have a UK subsidiary also in that structure, which is a common structure in the insurance space. The UK would get the tax money in relation to the $100 earned by the Bermuda subsidiary. Now, and these rules would go into effect over a phasing of schedules, I guess. The 2024 is the kind of initial year that's being thrown around. That is the expectation. That is the first year that our parent company example. So if we had a French parent and a Bermuda subsidiary, the French parent would pay tax in 2024 in that scenario. And again, in the second scenario, if we have a Bermuda parent and a Bermuda subsidiary, but a UK subsidiary as well, that rule would go into effect in 2025, is the current plan anyway. So there is a phasing of these rules, but ultimately the target as today is by 2025, the global minimum tax is achieved under one of those two mechanisms. Specific to Bermuda is interesting is there's these tax assurance certificates that companies have that advise that you know should Bermuda bring in an income tax regime or other type of tax regime, that these companies would not be subject to that tax regime until 2035, and that's one of the kind of questions that things are being considered as to how's best to bring these rules in, given there's really no escape is the plan under the two regimes, and how best to bring these in, particularly with the other aspects that are out there, including things like this tax assurance certificate.
Interesting. Very, very complicated new set of rules for people to get their heads around, I suppose. So is this one of the things that's really keeping your team particularly busy at the moment?
It is something I think it's not only specific to my team, but the tax world in general. This is certainly topic number one across most tax directors as well as other tax professionals. The rules are still kind of in proposed form. Each country has to bring in these rules individually, albeit there's kind of a template set of rules that the OECD has produced for how countries should go about bringing this in, or at least considering bringing it in. But so it is still in flux, albeit that 2024 is not far away for these to bring in, and it's kind of a whole new tax system. And in the U.S. tax world, you have federal taxes, state taxes, local taxes. This could be a whole nother tax regime that kind of works separate from those more kind of bespoke, specific taxes, such as U.S. federal taxes, or companies that were never subject to tax previously are now part of tax calculations because of this global regime that is looking to be brought in.
Yeah, very interesting. That's a very interesting point. So moving on from that side of sort of the tax regime and what's coming in globally, how do you and your team help insurers, reinsurers, and other entities with tax requirements they might need to consider when they're working with third-party investors? So specifically here, I'm thinking about in the insurance-linked securities space.
Sure. So as I said earlier, the big aspect of our practice is the U.S. investor reporting. So a huge capital market industry in the U.S., a lot of U.S. investors looking to deploy that capital. And the U.S. tax system has a very, I would say, complex and onerous reporting mechanism, right? They can't make a Bermuda entity, for example, file U.S. tax returns, but they can make U.S. investors going into an offshore jurisdiction include a lot of different forms and pick up tax in many different ways in relation to their foreign investment. So what our practice does, particularly in the ILS space, there's the control foreign corporation rules, which we call CFC rules for short, and then also the passive foreign investment company rules, or PFIC rules. And those cause basically current taxation on the income earned in a foreign jurisdiction. And in the ILS space, most of these structures are either CFCs or PFICs, and our practice specializes in giving the information that those U.S. investors need to complete their tax returns and satisfy their reporting requirements for making that foreign investment.
Right. Okay. And then on the other side of that, obviously, that's you help out so the investors know what they need to pay. But how do you help the ILS fund managers as well when they're navigating the complex needs of their investors when it comes to tax arrangements? And I suppose they're also navigating that across multiple different jurisdictions sometimes.
Sure. So it is interesting, in particularly in the Bermuda market, and I think ILS vehicles are often set up, maybe affiliated to a Bermuda reinsurer already, or affiliated to an asset manager based out of the U.S. And what's interesting in speaking with those two different groups is, the Bermuda reinsurers are familiar with the types of rules that require you to do certain activities from Bermuda. In the fund space, there's a safe harbor that allows for, say, a New York-based asset manager to be in New York, make performance trading activities from New York, albeit for a Bermuda or Cayman fund. This safe harbor allows them to be New York-based, even though it's for a Bermuda or Cayman fund. In the insurance world, that safe harbor does not apply. It applies to the investment world, but not the insurance world. And it's an interesting conversation, particularly with those asset manager-backed ILS vehicles, to explain to them what has to happen in Bermuda and the people they need to get in Bermuda to satisfy those requirements to mitigate the risk that they've somehow created a taxable presence in the U.S. So we work with a lot of clients around just the optimal structure, but also the where are the people functions and the activities that need to happen from Bermuda to achieve that optimal tax result.
Very interesting. Thank you, Scott. I really appreciate you sharing some of your insights into the global tax environment with us and also the work your team does to support clients in the industry. Great to talk with you today.
Great to talk with you as well, Steve.